All right, class, let's dive in. Today, we're tackling a topic that's absolutely fundamental to your future careers. We're talking about converting a registered retirement savings plan, the RRSP. And this isn't just some textbook theory. No, this is the real-world, high-stakes decision every single Canadian with an RRSP is going to face. So, I've put these materials together to give you that solid, foundational knowledge you're going to need. By the time we're done here, you'll be well equipped to start advising your future clients when they hit this really critical fork in the road in their financial lives. So here's our game plan. We're going to start with the why. Why you have to convert. Then we'll break down the three main choices: the life annuity, the fixed-term annuity, and the RRIF. We'll put them side by side to see how they stack up, and we'll wrap up with the single most important date in this whole process. So let's get into it.
Okay, first things first. An RSP is an amazing tool for saving money and pushing off taxes, but it's not forever. It has an expiry date. You can't just let your money sit in an RSP indefinitely. The government says that this savings account has to, eventually, become an income account. Its whole job flips from growing your money to paying that money back to you.
And that's where this term pension vehicle comes into play. It's just the official name for the tool that turns that big pile of savings into a steady, reliable stream of income. Now, here's what's really important to remember. Even after you convert, any money left in the plan keeps growing tax-sheltered until you take it out. So that tax deferral benefit doesn't just disappear overnight, which is great.
All right, let's look at option number 1, the life annuity. I want you to think of this as the choice for clients who want maximum peace of mind. They want a paycheck that they know, for a fact, will never ever run out, no matter how long they live.
How it works is pretty simple, actually. Your client takes their entire nest egg, let's say they've got $500,000, and they basically trade it to an insurance company. In exchange, that company gives them a contract, a promise to pay them a set amount of cash every single month for the rest of their natural life. It's a simple swap, a lump sum for a lifelong income. But here's the catch, and listen up, because it's a big one. On one side of the coin, because the insurance company is taking on some risk, life annuities often give you the biggest possible monthly paycheck. That $500,000 might generate way more guaranteed income this way than any other way. But on the other side, there's a huge risk of forfeiture. If your client passes away earlier than expected, the payments just stop. And the rest of the money? It doesn't go to their estate. The insurance company keeps it. It is a high-stakes bet on longevity. Now, you can help clients manage that risk. The payment they get is based on their age and whatever interest rates are at that moment, but they can add features. For example, a guaranteed term, save for 10 years. If they pass away in year 3, the payments keep going to their beneficiary for another 7 years. They can also do a joint life annuity to cover their spouse. But here's the key piece of advice. Every single guarantee they add lowers the risk, but it also shrinks the size of that monthly payment. There's no free lunch. And here's a little golden nugget for you as future tax planners. After age 65, annuity income qualifies for pension income splitting. This is huge. It means a higher income spouse can shift up to half of that income over to a lower income spouse, and that could seriously lower their combined tax bill. This is a massive advisory point. Okay, on to option number 2. This is the fixed-term annuity. If the life annuity was all about income for life, this one is all about making sure every last penny in that RRSP gets paid out, no exceptions. With a fixed-term annuity, there is zero risk of forfeiture. None. The contract guarantees the entire RRSP balance will be paid out over time. And the timeline is just calculated from when they start until they or their spouse turn 90. So if your client converts at 65, they get paid for 25 years. And if they pass away before 90, the rest of the payments just go to their beneficiaries. Simple as that. So the key features here are pretty straightforward. First, the piggy bank is guaranteed to be emptied out. The full value gets paid. Second, the finish line is always age 90. Third, payments are usually the same amount every time, which makes budgeting easy. And finally, for clients who still want a piece of the market action, you can sometimes tie the payments to investment returns. So it's certainty of payout, but not necessarily income for your entire life. And now for our third option, and I'll tell you, this is by far the most popular one in Canada. It's the Registered Retirement Income Fund, or RRIF. This is the go-to for clients who value flexibility and control more than anything else. You can think of a RRIF as basically just the next chapter for an RSRP. The money is just moved over, and it stays invested in whatever your client chooses.
The big changes are you can't put any more money in, and you have to start taking money out. The government sets a minimum percentage you have to withdraw each year, but, and this is key, there is no maximum.
And this slide just perfectly lays out the RIF's central trade-off. The flexibility? It's incredible. Need to fix the roof? You can take out a big lump sum. Markets are hot and you don't need the money? Just take the bare minimum. But with all that control comes all the risk. Your client is on the hook for all the investment risk. If their $500,000 RIF takes a hit in the market, their balance shrinks. And if they take out too much, too fast, they face longevity risk, the very real danger of running out of money.
And just like with the annuities, you can't forget about that income splitting opportunity. Starting at age 65, RRIF withdrawals count as eligible pension income. So yes, that same 50% split with a spouse is on the table. This is an absolute cornerstone of retirement tax planning, so don't forget it.
Okay, so we've looked at all three options on their own. Now let's do the important part. Let's put them side by side. This is the exact conversation you're going to have with every single client. And the question is never which one is the best. That's the wrong question. The right question is, which one is the best for this person sitting in front of me? You have to look at their risk tolerance, their health, their family, other sources of income. It all matters.
You know what I love about this chart is how clearly it just lays everything out. If your client wants flexibility, the RRIF is the hands-down winner. No contest. If they want to guarantee that their family gets all the money, then both the fixed-term annuity and the RRIF do that, but the life annuity doesn't. If they want the absolute highest guaranteed monthly income, the life annuity is often the champ. And look at the risks. They're just mirror images of the strengths. The risk of the life annuity is dying too soon. The risk of the RRIF is living too long or having bad market luck.
Okay, we've talked about the what and the how. Now for the when. And this is a hard, non-negotiable deadline that you and your clients cannot afford to miss. The magic number is 71. I want you to burn this number into your brain. 71. That is the absolute latest age that someone in Canada is legally required to convert their RRSP into one of those income options we just talked about.
And let's be super specific about this. Your client has until December 31st of the year they turn 71. That's the deadline to get the paperwork done. They don't have to start getting paid right away. The income can start flowing in the next calendar year. But the decision has to be locked in by that date.
So what happens if they just forget or do nothing? This is the point you need to stress. The consequences are absolutely severe. Their RSP gets deregistered and the entire value of the plan gets added to their income for that one single year. Think about that $500,000 RSP. All of a sudden, that's $500,000 of extra income, and it's getting taxed at the highest possible rate. It is a completely avoidable financial catastrophe.
And that brings us right to the end, to the one question that really sums it all up. When you're sitting with that client, the whole conversation, all these options, it all boils down to this. What are you more afraid of? Running out of money while you're still alive, or dying too soon and maybe leaving less behind for your loved ones? Helping your client find their own answer to that question, well, that's the heart of being a great advisor.